Hey, welcome to Mr. Market. Thank you so much for joining me. We're now to episode 19. Last week was pretty volatile for the market. It was down as much as 1.9% through Wednesday. And then on Thursday, after we had ironically a pretty bad GDP number, the market rocketed up and continued all the way through the end of the week, ending up about 0.9%. Now, the thinking with this reaction is that now that the GDP numbers are starting to soften a little bit more, the market is expecting the Federal Reserve to pretty much stop raising rates after their interest rate decision coming up this Wednesday. And that's considered a bullish side because ever since the Fed started raising rates last year, that had provided the biggest headwind to the markets. We had a pretty good week too. We were actually making money even as the market was dropping hard through Wednesday, but all that relative performance got wiped out, so you never really got to tell how good we were doing because the market reversed by the end of the week. For the week, we were up $1,628, which put us year to date up $28,812. And as a reminder, our goal is to earn $50,000 a year and earn 20% a year from a $250,000 portfolio. So we're 57% of the way of our annual goal, and we've been able to get there in just 4 months. So for today, I want to talk about the Fed's upcoming interest rate decision this Wednesday, plus how I also navigated through this week's biggest earnings reports. So let's go take a look at some charts. So the Fed is expected to raise interest rates by 0.25% this week and then stop. Now that part is bullish, but the market is also expecting the Fed to cut rates later on this year. And the Fed has said, no, we're not going to go do that. And that part is bearish. And that makes me think of the market's reaction will be a lot like this conversation.
Hey Chad, in one word, how are our investments doing?
Good.
Okay. How about in 2 words?
Not good. Also, once the Fed stops raising interest rates, what happens to the market typically? Well, if you look at the past data, historically, the market's reaction has depended a lot on the shape of the yield curve when the Fed has stopped raising interest rates. Historically, when the yield curves have behaved normally, that is, when short-term interest rates are lower than longer-term interest rates, when the Fed has stopped raising rates, the market has risen afterwards. But when yield curves have been inverted, like we have today, when the Fed stopped raising rates, actually the market has fallen after. And so that's kind of the playbook that I've got in mind for this type of cycle. You know, the yield curve is sharply inverted. We have a lot of indications that the economy is going to go into recession, and recessions are not good for stock prices. So, that's the playbook that I have in mind, but I do need to keep an open mind that, there's always a first time for everything. We have this expectation that the market will drop, but if the market continues to rise, I need to be ready for that, and I need to trade my positions accordingly. Now, let's talk about the stock market, and let's take a look at some charts. This week for earnings, I played Amazon, and as you can see, it had a pretty healthy uptrend going into earnings. So I put my strike prices at $95 and $125, and when earnings came out, I was still within the boundaries, so I won that trade. My next earnings play was Google, and as you can see, this had a pretty healthy uptrend going up into earnings. So I put my strike prices at $95 and $120. And if you take a look at the upward sloping channel, you can see there was an upper boundary up at $115, but I wanted to be conservative. And it worked out, and I was able to make money on both trades. Next was Facebook, and this one had a strong uptrend going into earnings as well, so I wanted to just play this safely, and I sold puts at $170. I did not want to sell calls on this because of the strong chance that it could jump to the upside, which it did. And my last earnings play was Microsoft. As you can see, this one had a strong uptrend heading into earnings. It did pull back a little bit right before, but I wanted to go play with fire a little bit on this one, so I put my strike prices down at $255 on the puts and calls as high as $310. And I picked that level because that was the upper end of the upper trading range. It made me sweat for a couple hours there, but the upper trading channels gave it just enough resistance for the calls to expire worthless. So heading into this week, I'm short some puts at the $400 strike price, $399, and $395. I'm still pretty bullish now that the algo is positive, and I still have some puts that I keep rolling every single week for the bank ETF, KRE, at the $40 strike price. The trends on that one are still pretty horrible, so I'm still keeping my bet sizes small. And remember, even if you have a bet in something that could potentially lose you money, as long as you keep your bet size small enough, it's okay to have that. As I like to say, if you master the bet size, you master the game. And if you have a position that you may lose some money in, I think it's good to keep that position size small so you don't get hurt in case you are wrong. But in case you're right, it's still going to pay a meaningful enough premium that it'll make the position worthwhile. So that's all I've got for this week. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. Or you can find me at my new domain, mistermarket.us or mistermarket.us. So thanks again for joining me, and I will see you next week.